for tech, this is a dream scenario. And in my opinion, it puts new tech highs now back on the table for 2025.
Just as Coinbase and other tech stocks grapple with export restrictions, there's fresh momentum from Washington. The latest U.S. China tariff easing agreement has sent positive ripples across the tech sector. While the deal doesn't completely reverse prior sanctions, it does provide greater clarity and reduced uncertainty for semiconductor and hardware companies, especially those with global supply chains and exposure to Asia. Stocks surged on Monday as the U.S. and China announced a deal to temporarily reduce their high reciprocal tariffs, leading to much optimism that a global economic recession may be avoided. In this video, I will be revealing 3 tech stocks that are about to pop and could turn today's fear into tomorrow's fortune. If you're tired of sitting on the sidelines while the market moves without you, now's your chance to make bold and informed decisions. But please, let's help get 500 likes on this video. With you, it's possible. Subscribe to the channel if you're new, tap the bell notification so you don't miss out on new content like this. Note, I'm not a financial advisor, and this is not financial advice. So always do your due diligence. And I would appreciate it if you could try answering the question at the end of this video. So let's get straight into it. Let's start with Coinbase Global Ticker Coin, the largest US-based crypto exchange, is set to join the S&P 500 index before markets open on May 19th, replacing Discover Financial Services DFS following its merger with Capital One. While the news has already triggered a strong aftermarket rally plus 9%, the real impact may just be beginning, and for investors, this could mark a major buying opportunity. Joining the S&P 500 is more than symbolic, it's transformative. It reflects financial stability, institutional credibility, and opens the floodgates for passive inflows from index-tracking funds, ETFs, pension plans, and model portfolios. Here's how this inclusion could directly benefit Coinbase stock. Forced buying from index funds. More than $15 trillion in assets track the S&P 500, with over $7 trillion directly benchmarked. When a new company joins the index, passive and active managers are required to buy the stock to match the new index weighting. Juan Leon of Bitwise estimates S&P inclusion could force up to 7x Coinbase's daily trading volume in institutional buying. This surge in demand often leads to a sustained price appreciation, not just a short-term pop. Legitimization of the crypto sector. Coinbase becomes the first pure-play crypto company ever added to the S&P 500, a historic moment for digital assets. It signals that the crypto industry is becoming entrenched in mainstream finance. Institutions that have long shunned crypto now gain indirect exposure via index holdings. Coinbase's business model, spanning consumer trading, institutional liquidity, and blockchain infrastructure, is now being viewed on par with blue-chip financials and tech firms. Despite crypto volatility, Coinbase has met all S&P eligibility criteria, including 4 consecutive quarters of profitability. Trading volume has surged alongside Bitcoin topping $100,000, which directly benefits Coinbase's fee-based model. Although 2025 YTD performance is down on 7%, the company has shown operational discipline and strategic alignment with institutional demand, a key reason it now qualifies for the S&P 500. Coinbase stands at the nexus of 2 converging megatrends: blockchain adoption by institutions, governments, and developers, investor appetite for alternative assets, especially as inflation concerns and fiat skepticism persist. As more crypto ETFs, sovereign fund allocations, and enterprise blockchain integrations roll out, Coinbase is ideally positioned as the go-to platform for compliant, regulated crypto exposure. The S&P news comes as market sentiment toward digital assets is turning decisively positive. Bitcoin above 100K, setting a bullish tone. Ethereum upgrades, rising stablecoin use, and tokenized assets are reviving interest in on-chain innovation, exactly where Coinbase is expanding. Coinbase shares surged to $225 in after hours, up nearly 13% from Monday's open, and could retest 2021 highs, $357 if momentum continues. Coinbase is more than a crypto exchange. It's evolving into a financial infrastructure provider for the next generation of finance, a potential inflection point for long-term value appreciation. For investors looking for asymmetric upside in a market-beating name with tech and financial exposure, Coin deserves a serious look right now. Moving on to the next stock in the list, Advanced Micro Devices Inc., ticker symbol AMD. Why does this latest tariff deal matter for AMD? Reduced tariffs on certain tech components could lower input costs, helping AMD maintain healthy margins. The easing signals a potential de-escalation in trade tensions, which has already boosted investor confidence in tech stocks. While advanced AI chips still face restrictions, improved trade terms for broader categories may allow AMD to reallocate inventory and optimize international sales beyond China. This deal adds another layer of support to AMD's broader narrative, one of strategic flexibility, global positioning, and long-term resilience. With a data center and AI growth, revenue and margins are strengthening, driven by 5th-gen EPYC and the new MI series chips. AMD continue with its strategic moves by acquisitions and partnerships are expanding the company's AI footprint and boosting market share. Export controls, tariffs, and operating expenses are pressuring margins and global sales, while inventory and competition remain concerns. For Q1 2025, AMD beat Wall Street expectations with revenue topping $5.5 billion. Net income also rose, signaling solid cost control amid a challenging macro backdrop. AI demand was a key driver, with the data center segment seeing robust year-over-year growth. AMD's MI300X GPU is gaining traction, especially among hyperscalers like Microsoft, Meta, and Oracle. Their AI GPU business is on track for $4 billion in 2024, and rising. What sets AMD apart? Openness. Their chips allow easier customization of AI frameworks, a contrast to NVIDIA's vertically integrated approach. Meanwhile, EPYC processors are fueling growth in enterprise and cloud with major adoption across AWS, Azure, and Google Cloud. Analysts expect AMD's revenue to grow 10.2% annually over the next 3 years, despite geopolitical hurdles. Over 5 years, AMD delivered an 83.44% total return, though it lagged the broader market over the past year. Still, that longer-term strength underscores its potential rebound, especially with AI driving the next phase. Despite current success, AMD's share price trades at a 36% discount to the consensus price target of $133.98, suggesting further upside. While NVIDIA controls 80–90% of the AI GPU market, AMD is emerging as a credible alternative, especially as demand for diverse solutions grows. Intel, meanwhile, continues to stumble with delays and inconsistent delivery in both foundry services and AI chips. Lisa Su was diplomatic in her interview, but AMD's momentum is clear. It's outperforming Intel in server CPUs and AI. Lisa Su emphasized agility, AMD's ability to respond to supply chain issues, tariff risks, and global regulatory changes. That includes reshoring production, diversifying manufacturing, and maintaining a strong balance sheet. Strategic acquisitions, like ZT Systems, are enhancing AMD's rack-scale AI offerings and accelerating hyperscaler deployments. Most analysts remain bullish, citing consistent execution, innovation, and adaptability. Q1 2025 may mark a pivotal moment for AMD, not just a quarterly beat, but a signal of long-term strength in AI, cloud, and enterprise computing. Despite export restrictions and fierce competition, AMD is executing. Lisa Su and her team are not just reacting, they're building a future-proof business. The timing of the tariff relief couldn't be better. With AI demand surging and geopolitical risk still looming, any opening in U.S. China trade is a green light for tech investors, and AMD is right in the path of that upside. Electric vehicle EV maker Rivian Automotive ticker REV surprised the market with strong Q1 2025 results, signaling meaningful operational progress and a firm step toward long-term profitability. Despite these encouraging developments, the stock remained range-bound as investors weighed cautious forward guidance and persistent industry headwinds. Rivian posted a loss per share of $0.41, beating Wall Street's estimate of a 0.76 loss. Revenue surged, and the company marked its second consecutive quarter of gross profit, $206 million, a critical milestone that triggered a $1 billion investment from Volkswagen, VW AGY, set to close by June 30th. Rivian now holds $8.5 billion in cash and short-term investments, giving it a solid buffer against near-term volatility. Despite the strong quarter, Rivian's stock initially dipped before rebounding to end the week flat. The muted response was driven largely by management's revised 2025 delivery guidance, now set at 40,000–46,000 vehicles, down from the earlier forecast of 46,000–51,000. This adjustment stems from expected impacts of new U.S. tariffs on imported EV parts, particularly batteries and semiconductors from Asia, which could raise production costs by several $1,000s per unit. The company also increased its capital expenditure forecast to $1.8–1.9 billion, up from $1.6–1.8 billion, to to address rising component costs and to invest in adapting its supply chain and manufacturing for the evolving trade environment. Rivian's long-term outlook is promising, but not without risk. The company faces supply chain vulnerabilities, negative free cash flow exceeding $5 billion over the past year, intensifying competition from both established automakers and other EV startups, execution risk as it prepares for the launch of its R2 model in 2026. A planned one-month production halt later this year for retooling its Illinois plant will temporarily slow output but is seen as a strategic move to support future growth. With only 2.9% of the U.S. EV market and a minuscule 0.23% global share, Rivian remains a small player compared to Tesla's 50% domestic dominance. In Q1, it delivered 8,640 vehicles, aiming for up to 46,000 by year-end, still a far cry from Tesla's 2 million annual deliveries. Yet, this underscores Rivian's early-stage growth potential. From a valuation standpoint, Rivian trades at 2.5x sales, lower than Tesla's 9.5x multiple, but still rich for a company not yet profitable. The EV market is projected to make up 26% of U.S. new car sales by 2030, and Rivian is well-positioned to grow with this broader trend. Strategic investments from Volkswagen and the $6.6 billion DOE loan bolster its expansion roadmap. If Rivian can continue cutting costs, scaling efficiently, and navigating macro headwinds, it stands to capture meaningful market share from traditional automakers. For now, Wall Street remains cautious. Of the 25 analysts covering Rivian, the consensus rating is hold, with a $13.80 average price target, implying slight downside from current levels. Rivian is not for the faint of heart. This stock is for contrarian investors who can stomach volatility and are willing to wait for real growth and profitability, likely post-R2 launch in 2026. With compelling operational progress, growing strategic partnerships, and a clearer path toward margin improvement, Rivian offers long-term upside potential for those with patience and conviction. I remain bullish, but will closely monitor quarterly delivery trends, gross margins, and cash burn to assess Rivian's trajectory towards sustainable growth. Coinbase is breaking barriers as it joins the S&P 500, a huge win for crypto legitimacy. Rivian shows real progress with rising revenues and a billion-dollar vote of confidence from Volkswagen. AMD continues to power ahead, riding the AI wave and outpacing tough competition. Whether you're betting on blockchain, backing the EV revolution, or riding the semiconductor supercycle, there's serious opportunity on the table. Which of these stocks are you buying, holding, or avoiding? Share your take in the comment below, and don't forget to like, subscribe, and hit the bell so you never miss another market breakdown. See you in the next one.